Finally, we're starting to get closer and closer to the meeting on 20th of September. And that's going to be the FOMC meeting. And I think a lot of people, a lot of investors, we're all looking forward to see what the rates decision is going to be from Chairman Jerome Powell. So, of course, right now, with the amount of information that we actually have, okay, mainly from the three different reports that just came out recently. The first one being the PCE, which is basically the inflation report that the Federal Reserve likely use a lot more than the CPI, but basically they do test about the same thing. For PC is just basically personal consumption expenditure, basically the items, the prices of items that we basically use in our everyday life. So pretty close to CPI. Okay, and then the next two different reports that we actually have are basically just jobs report. We got the jobs report, which is the job opening report, and then today we just came out with the jobs report that came out. Basically, everything is starting to show that they're all pointing towards the same direction of Jerome Powell keeping rates unchanged in the next meeting. So, of course, I think that a lot of time what happens here is that because when Jerome Powell came out during the Jackson Hole Symposium, he was relatively hawkish. Okay, he wasn't really giving us any space in his short about 10 to 20 minutes talk in the Jackson Hole Symposium. He didn't really give us any directions on where he believes the market is going to be going towards in terms of rates decision. So a lot of people were actually thinking that his tone were relatively hawkish. So a lot of us are thinking that, okay, because if Jerome Powell is still hawkish, probably you need a few more data that actually would want to disprove his whole entire mindset for us to actually have another 25 basis point increment in the next meeting. So of course, after the Jackson Hole Symposium, these three different reports that came out basically neutralizes the whole entire narrative that's saying that we do need a 25 basis point increment. Albeit, we do have, I believe, two more reports before the next FOMC actually comes out. I believe that we have a CPI and we do have another employment report. After getting these two different reports, of course, if the CPI shows a substantial decrease in inflation, well, a substantial disinflationary trend, or hopefully even a deflationary trend, then I believe this would be definitely enough for Jerome Powell to think, yeah, I think we are basically done, and let's just use whatever that we have already increased the rates to for the past 18 months and just let it ride it out all out. And hopefully that will just, ensure that we are basically in the clear. I think that's what a lot of people are expecting it to be. So yeah, the thing is, right now, I do think that we are basically closer to a 80% chance of us actually having rates remain unchanged. Simply because, like I explained, a lot of data set actually came out to prove otherwise, to prove that the hikes are completed. Now, where this 20% comes in terms of chances of a rate increase, okay, basically for a rate cut is completely out the window because I don't see that happening. Of course, unless if a recession were to hit or if a natural disaster were to hit, that sort of thing we cannot really predict. But in terms of just data alone, I would say like a 20% chance of still having a rate hike. So why still having a rate hike? It's because right now, inflation, as much as inflation has been going down, inflation is starting to peak. Okay, well, disinflation is starting to peak. There's no more deflation happening. The disinflation is not going down any further. Core inflation is still relatively high. And right now, we are unable to bring it all the way down to a 2% year-over-year basis for a long period of time. Basically, what we are actually expecting for CPI is by September or by October, We're expecting the CPI year over year to be below 2%. We're expecting it to be about 1.9% a year over year. And chances are it is not reflecting so. So if that were to be the case, then of course what would happen with Jerome Powell is because he thinks that they are supposed to aim for a flexible average inflation trend towards 2% in the long run. Right now, he is not getting the 2% because the last bit of inflation is being very, very persistent. So why is this last bit of inflation so persistent? Because whoever, people in the working class and below has been completely flushed out. People do not have excess cash. People are loaning money at a record level. Credit card loans, record level. Mortgage loans, record level. Everything is at the highest that it has ever been since like the 1990s. Even more than the 2008. Which is why a lot of people are out here shouting, it's going to be a recession. Everybody's here shouting, it is going to be a bubble. We just don't know it yet. But of course, a lot of people just keeps on thinking, nah, it's not a bubble, it's not a recession. The market is still going strong. So where does this narrative actually change? People from the middle class and above, the people with a lot more purchasing power than the working class and below, they are the one that is basically sustaining the whole economy. They're just spending money as much as they can. Even if they're not able to do so, they're gonna just take up a loan. And that's basically what's happening. Car loans are up, mortgage loans are up, interest rate loans are up, credit card loans are up, everything's up. Okay, and obviously all these kind of loans, of course you can actually argue the fact that most likely a lot of people in the working class and below do have a lot of these loans. I would say definitely so, because people with lesser purchasing power or people with lesser net worth and income would definitely get themselves into more debt. Makes sense. But the thing is that people in the higher echelon would also be the one that would be more, they would be able to sustain more debt. They will be more privy to more debt. They would know what debt can actually do for them, because not all debt are bad debt. They are good debts, right? So I do believe that there's this whole entire loaning bubble thing. But of course, I do not want to be this guy with his tinfoil hat telling you, hey, there's going to be a bubble. There's a huge bubble. We're all going to go in a crash. I don't think a huge crash would happen. I am very, very cautious. But I don't think we are going to be seeing like an 80% crash anytime soon. I think that the major recessionary fears are basically behind us. But I don't expect us to continue in a very, very straight line upwards. A lot of people are thinking that if you have already basically escaped a possibility of a recessionary trend or a recessionary fear, it means that stocks should only go like this. Which a lot of time that's not the case. What I am worried about is because a lot of companies, for example, Nvidia, them having a good earnings report shot them all the way up to about like $520 in the after hours. The next day, when they actually started to trade in the open hours, they basically traded all the way back down to about $460 again, which was the price that they were at before the earnings even came out. Of course, I do understand that some people would want to argue that, hey man, Nvidia is still going back up again after having multiple good reports, such as the Jones report, and of course having pretty good tech companies rally that happened a few days ago. Nvidia is starting to go back up again. Nvidia will most likely be looking at 500 and up. That is true. But you have to understand, when you're actually pricing a company, you have to price the company properly. Right now, Nvidia, the price to earning ratio for Nvidia does not make sense. And that's why I think this bubble would actually be in. People are now thinking that because the recession is behind us, they are becoming a lot more complacent when they invest in stocks. When they are complacent in investing stocks, what happened is that they're just going to think, yeah, I'm gonna buy this and this is going to be going up 30%, 40% by the end of the year. I think we're good. I'm gonna just buy this stock. This is going to go to the moon. And we're not even talking about meme stocks anymore, okay? We're talking about actual good companies out here. We're talking about Nvidia, we're talking about Tesla, we're talking about Apple, okay? We're talking about good companies here, okay? And all these different good companies are going up incredibly crazy right now. Nvidia went up like what, 200% in a year to date? Something insane like that, when what, the whole entire market is up like about what, 24% or something ridiculous. So yeah, it's fair to say that Nvidia is doing well, and of course, if you invested in Nvidia like I did, okay, I do have like an odd 80 shares in Nvidia, which I'm very very happy about, okay. And I'm not here to just dump on Nvidia, okay. I'm just saying that the PE ratio is relatively high, and a lot of people are not thinking straight when they're investing in this market because think the recession is over, okay. There's no more recession, there's no more bubble, there's no more huge dump in the market. Okay, no one's going to be short selling the market like crazy back in 2020 or in 2021, that sort of thing. And I think with this sort of mentality, they will just be like, you know what, I'm just going to put all my money into the market. We are going to be fine. We are just going to be investing all our money and we are going to be fine. I think that's the mentality that a lot of investors are having right now. Which is why I just want to be the second opinion or the second voice giving you the sort of reason to tell you that, maybe do not go all in. Maybe hold a little bit of cash. Of course, if it happens to go to the moon, you might not earn as much. But if it goes to the dumpster, at least you're not going to be losing your whole entire net worth, you know what I mean? So yeah, I think this whole entire recession talk, it's a pretty tough one because I do think that there's two very big camps right now, and people are not really staying in the middle anymore. I think people are on pretty huge extremes. You're either in the bull camp or you're in the bear camp, and they are pretty adamant on their views and their narratives on it. So it's very hard for us to actually explain this whole entire thing. And let's not forget, election is coming up as well. Even though for Singapore, as of today, Singapore just went through the election, and it was pretty interesting because this is the first time I voted for a president in Singapore. So, hey, pretty cool. Okay, I think it's the first time in 12 years. So, yeah, interesting stuff. But yeah, the election in the United States is going to be happening in 2024. Right now, they're starting to do a little bit of campaigning, a little bit of interviews, a lot of debates happening with the Republicans as well. I believe the Democrat debates is going to be coming up pretty soon. You're going to see a lot of left-wing media, right-wing media fighting it out. Okay, and this is also where bills get signed in. This is where promises are made and markets move according to those promises. The Democrats or the Republicans, any of this side, they would actually fight to say, under my presidency, I would ensure that the market will be booming. We can ensure that the economy will be booming. This is how we're going to be doing it. And of course, according to those so-called like approval ratings or like winning ratings, in simpler terms, for this presidency, a lot of them will think that, oh, okay, if the Republicans are going to win and if he's promising such things, then maybe we can just invest in the market. And of course, if they do think that, okay, this guy is most likely going to win, but he's not going to be caring about the economy, maybe I don't have to plow all my money into the stock market. Maybe I'll just keep it on hold. What would actually happen in 2024? We do not know. Okay? The thing is that in a presidential election, a lot of things can happen. There's a lot of if and what ifs. And people would talk about what they would want to do. People will predict what will happen. But nothing is confirmed, which is why it's a little bit scary. Okay, and you're going to see a lot of volatility during the whole entire campaigning period for the President of the United States for 2024. So yeah, of course, I think that it's going to be pretty interesting for us to actually go through the whole entire time period for that. And let's not forget that that's going to be also affecting a little bit on the Federal Reserve, which is something that this channel has been talking about a lot as well. Because even the former President Trump, he was talking about firing Jerome Powell the moment he become president and things like that. And these are the different sentiments that might probably or potentially move markets. And these are the kind of things that you have to look out for on the news. And this is why you should not just subscribe to one news outlet. You should subscribe to multiple, because it's very, very awkward, because politics in the United States is so shrewd, where different news outlets report different things. So just try your best to consume as much content as you can on a lot of different news outlets and just form an opinion on your own. That's the best that I can do, and that's what I try my best to do so on this channel, so that I can give you guys my opinion on market, on this economy, in this weird ass economy. But yeah, anyway, I'm gonna be looking forward for the FOMC meeting. I might be doing an expectation video, but I think that's gonna be a pretty quick one, so I might be putting it together with the CPI video. But anyway, that's all I have for this video. Thank you so much for watching, and I'll see you guys in the next one. Peace out. Bye.